Good evening, everyone. Welcome to this evening academic session, which will be dedicated to ESG. As you know, ESG is a key topic from CFA Society France. The ESG committee led by Gabriel has proposed lots of initiatives over the past few months, which are supported by Alex Iniesta and together with Patricia. They launched the ESG certificate back in March. And we are pleased to announce that we just passed the 100 mark of candidates running for the ESG certification, and this registration are accelerating over the past few weeks. So this evening, we will cover ESG from a particular angle. We will look at behavioral finance and asset allocation. And for this, I'm pleased to introduce Marie Brière, the author of the research paper, Personal Value, Responsible Investing, and Stock Allocation. You certainly know Marie Brière. Marie is the head of Investor Research Center at Amundi. She's also the professor at Dauphine University. She's also a researcher at the Solvay Business School. And Marie is the author of several papers on asset allocation and behavioral finance. She wrote a book in 2004 on interest rates, anomalies, and collective beliefs. In 2014, Marie received the Markowitz Award for an article published in the Journal of Investment, an article on sovereign wealth and risk management. As usual, this academic session is a forum in between the academic and the practitioners. So it will be a very interactive session. Don't hesitate to ask your question by chat during the presentation. And after that, we will have a Q&A with Marie. Marie, the floor is yours.
Okay, thank you very much. Can you hear me correctly?
Yep.
Okay, okay, thank you very much, Jean-Philippe, and thanks for this kind introduction and for your invitation to this seminar. It's a great pleasure for me to present this research that we are conducting with Stefano Ramelli, who's at the University of Zurich, and which is about responsible investing and stock allocation. So just to give you a little bit of background of why this work, as you are well aware, social responsible investing is really increasingly popular among retail investors. And if you just look, for example, in Europe, it represented only 3.4% of the market for social responsible products in 2013. It is today accounting for more than 30%. And we could experience exactly the same trend in the US, where SRI assets are 25% retail products today in the US. So there was a tremendous growth in the appetite from retail clients into social responsible investment. And that led also to a growing demand for SRI in pension plans, so for retirement benefits. And most of the debate around this question was, especially in the US, on the desirability in terms of fiduciary duties and financial returns. I mean, you've probably seen all the debate in this summer and in September around the question, should we allow social responsible assets to be in pension plans? And Trump was very vocal against that and proposing a new rule to only focus on the financial returns and exclude the impact measurements that we could also consider for social responsible investment. So that was the bulk of the debate. And there was an overlooked point, which is the point that we're going to look at in this paper, and which is the following question: does the offering of responsible funds affect investors' portfolio asset allocation and risk-taking behavior? So we're going to look at this question and measure that from actual investment in pension plans. But before we go to more detail in what we did in this research, I would be very happy to ask you a very quick question. So I hope we have enough people participating. And the simple question, do you invest in the stock market? Simple answer, yes or no. And I would like to see how much of you invest currently in the stock market. We have a particular sample, right? Because all of you are financial professionals. But let's see what the answer. Yes, 87%. Yes, you're certainly not a representative sample of the French population. I'm going to show you later on what is the outcome if we look at retirement saving vehicles. So it's a very high figure. And it's even higher than what we experience in the US, right? In average over the US population. So these are the figures about the US stock ownership. And you can see that it's relatively moderate. So the percentage of yes is around 55% today. It was started at 60 in 1998, and it decreased tremendously during the global financial crisis. And it reached a low in 2013 at 52%. So 52 US people investing in the stock market. So this low stock market participation, and I show here US figures, but it is pretty much the same in Europe, and figures are even lower, around 20% participation in Europe, depending on the countries. But it's a key topic in household finance. It's a real challenge and also a policy objective because, as you're aware, there can be large welfare effects. If you don't invest in the stock market and if you're not able to capture the equity risk premium, it might have large consequences at retirement if you're not able to benefit from this risk premium. And potentially also inequalities between low-income people that invest less in the stock market and high-income people that invest more in the stock market. So that's a key question and a policy objective. Now I'm willing to ask you a second question. I'm changing a little bit the question, and I'm now asking you, if you were offered a socially responsible fund investing exclusively in companies promoting positive environmental and social impact, so socially responsible investment, would you invest in the stock market? Yes or no? Yes, interestingly, 94% of you now answer yes. You were only 87 before. So that's exactly the question that we're going to investigate in this paper, in this research. More people are willing to invest in the stock market. That's what we are also finding, of course, with different numbers, but in this research, when they are offered social responsible investment. And why is it the case? It's a very interesting, important question. So coming back to our stock market participation puzzle, it has been widely studied in finance and especially in behavioral finance. And academics have tried to find good explanations for that. There were various factors that were evoked to explain this puzzle, starting from financial factors, like, for example, informational cost. It's complicated to invest in the stock market. It takes time, it requires efforts. You need to monitor that over time. So that could make some people more reluctant to invest. Then there are, interestingly, pure behavioral factors, starting from financial literacy. For example, it has been shown that people with lower financial literacy, they invest less in the stock markets. Optimism also plays a role. So people that are less optimistic invest less in the stock market. Very importantly, and there is this famous paper by Malmandi and Nagel showing that earlier life experience plays a role. So if you lived in a period where you experienced bad performance of the stock market, you're less inclined to invest in the future in the stock market. So if you experienced financial crisis yourself, or if the performance of your investment period was not so good, then you're less inclined to invest in the future. And also interpersonal trust. So how much you trust others in society, in your life, also has an impact on your stock market participation. And on top of that, and that's probably the factors we're the most interested in here in this paper, social and cultural factors play a role. So this has been demonstrated recently. There is something that we call stock market aversion. So some people dislike financial markets, capital markets in general, and are not willing to invest in stock market because of this aversion. This aversion is related to social capital. It has been shown by Guizzo and co-authors. It's also related to political preferences. For example, in the US, it has been shown by Kostia and Torstila that Democrat individuals are less likely to invest in the stock market than Republicans. And also they differ in the way they invest in social responsible investment. So there are big differences depending on political preferences. So based on that, we formulated our hypothesis. So first, we know that there is stock market aversion. At least we know it from academic studies in the US, but it's quite likely that this happened also in Europe and also in France. So pro-social investors, so we are going to call them pro-social or ethical. It's hard to qualify them very precisely. But pro-social investors are less likely to invest in stocks because of a generalized antipathy towards capital market. And we also know that personal values have an impact on social responsible investment. These pro-social investors, they're also more inclined to invest according to social responsible criteria. This has been shown among the US population, but also among fund managers. And there is this famous paper showing that if you look at donations that fund managers do in the US to the Democrat or Republican Party, it is related to how they invest in socially responsible funds. From these two hypotheses, we build our conjecture for this research. So if you combine 1 and 2, responsible funds should allow pro-social investors to invest in the stock markets while avoiding the cognitive dissonance of investing against their value. So the offering of social responsible funds could increase stock market participation. So this is the hypothesis we formulate, and which, by the way, has been validated by the very small poll that we've been running just before. So to test this hypothesis, we analyzed the portfolio choices in 2017 of approximately 1 million active participants in employee savings plans in France. And what we find is that the inclusion of responsible equity options in the funds menu is associated with an increase in stock market participation by the plan participants. So in average, people that are offered social responsible products, they invest 2.2% more in equities, relative to an average of 20.9%, so it's a 17% increase, quite sizable. And we also run a diff-in-diff analysis. I'm going to come back on that later. And here we show that the treatment of offering social responsible funds in the funds menu increases participants' appetite to stocks by 6.8%. So what's our empirical setting? We are analyzing savings plans in France. So you're certainly very familiar with that because you probably have one yourself. We're looking at épargne salariale plans, which are very close in principle and in functioning to pension plans in the US, like the 401k, for example. Widely used in France in the private sector, so 56% of French employees have access to at least one form of such savings scheme, according to the DARES. So it's something which is really widely used and very representative of what people are offered, at least employees working in private firms. So I'm sure you're well aware of these savings plans. So employees receive variable remuneration called participation and intéressement. They can also make voluntary contributions to the plan, and possibly this money is matched by the employer. So that's what we call the abondement. And there are two main types of employee savings programs. There is a long run one for retirement called the PERCO. And then you have medium-term savings plans called PEE. The difference between the two is the length of the blocking period. So in the first, you're blocked until retirement. In the second, you're blocked until 5 years. And there are ways to unlock these savings if you buy your house, etc. And the employees can choose freely their asset allocation among a funds menu, which is proposed by the employer. So the employer designed the funds menu, and then the employee has to choose how to design its asset allocation. Interestingly, there is also a default option. So if you don't know how to choose, you can just take the default, which is by law supposed to be a low risk fund, either a life cycle fund or balance fund or a money market or fixed income fund. So that's the setting. Very interestingly, and that's very special and unique to France, there are responsible funds offered in the savings plan, and this is mandatory by law. And that's really unique to France. Since 2010, all firms that have more than 50 employees, they must include at least one solidarity fund among the investment options. What is a solidarity fund? It's a special fund that requires to invest 5 to 10% of assets in accredited solidarity-based enterprise that should have a social utility. So what are these firms? They are very different, but in terms of sectors and coverage, they tend to focus, for example, on housing, access to employment, especially for disabled people or long-time unemployment people, education, preservation of the natural resources. So the Solidarity Fund invests in average 6% in these solidarity-based assets, and the rest, the 94% of the residual assets are invested in normal stocks, I would say, with a socially responsible focus. So we're going to look at solidarity funds, and what I will design as responsible investing in this study is only solidarity funds. And there are 3 reasons why we do that. First is that the solidarity funds have common characteristics which are defined by law, and they are accredited by Finansol, etc. So there is no leeway in the way you can define a solidarity fund. They are also by law mandatory in the pension plan, so there are less concerns about the endogeneity nature of the responsible fund offering. So that, for example, a firm that would be more social responsible would be more prone to propose to its employees social responsible funds in the menu, for example. Here, everyone should have them. And the third point is that there are also the solidarity funds are well known by French employees. And here I quote a survey that has been done for Vigeo Eiris and the FIR, asking people how much they know about social responsible products. And they were asked about crowdfunding, about solidarity fund, and about social responsible investment in general. And as you can see, solidarity funds are quite well known, and it's also increasing through time. In 2019, 67% of people that were surveyed knew what was a solidarity fund. These figures are much lower if you consider social responsible investment, where only 35% of the surveyed people know exactly what it is. So it's a product which is widely spread, well known by French employees, and which is used by all plans. We are going to analyze the cross-sectional portfolio decisions in 2016 and 2017. As I told you, we're analyzing the portfolio decisions of close to 1 million employees in around 18,700 firms, covering all France, 94 out of 96 French departments. So all plans in our setting include at least one solidarity fund, which can be either an equity fund or a balanced solidarity fund. And half of the plan include one solidarity fund, either equity or balanced. And 13% is the average weight which is invested in equity funds at the end of 2016. These are some summary statistics about what I just said. So you have on the top table the summary statistics at the plan level variable. So as you can see, 22% of the firms are offering a solidarity, let's call it social responsible equity fund. And interestingly, that the second highlighted the line here, in 2017, 1% of the firms introduced a new solidarity fund in their funds menu, so new offering of a social responsible fund. If we now look at summary statistics for individual, you can see that at the end of 2006, and that's the second line here, 12.9% of the participants were investing in the stock market. So much lower figure than what we had in the poll. If you look at the way the new contributions were invested in 2017, so the new money in 2017, we reached a figure which is close to 14%, 13.96. And if you look at the increase in equity investment between 2016 and 2017, for those that were already in the plan in 2016, you find a 4% increase in average in the equity investment. So here comes our econometric specification. So the way we're going to measure the impact of introducing solidarity funds in the funds menu, we do it in two different specifications. The first one is just a cross-sectional regression, which is designed to compare the share of new contributions allocated to stocks in 2007 in plans that offer responsible equity fund and plans that do not offer responsible equity funds. The way we do that is just by regressing the percentage invested in equity in 2017 on a dummy variable, which is equal to 1 if the plan is offering a responsible equity fund option. And also, of course, a number of controls for the individual characteristics and the firm characteristics. So that's the first type of regression we're going to run. In a second type of regression, we are going to run a what's called in diff regression, so difference in difference, which is a kind of regression we use in medicine where we want to look at the impact of a treatment. So you have two different populations, one treated population that receives the treatment of being offered a new solidarity fund in 2017, and you have a controlled population and control group, which is not offered a new solidarity fund in 2017. And we are going to compare how these two different groups behave in 2017 relative to what they were doing in 2016 to see if there is a difference in the way they allocate their funds to equities. So it's really, these different settings are really inspired from what we do in medicine, where we try to see if there is a different reaction to a treatment, comparing a treated and a control group. Again, we add firm and individual characteristics in the econometric specification. So let me show you the results. So these are the results of the cross-sectional regression. I'm going to highlight the result here that are of interest. So we are looking at the impact of being offered a responsible equity fund in the funds menu on the way people allocate their funds to equities in 2017. And we're going to be interested in the first line here. So the impact of this dummy variable for responsible equity fund offered. And as you can see, participants in savings plans that are offered responsible equity funds, they have a 2.2% higher average asset allocation to stocks than the rest of the population. Interestingly, we also interact the dummy variable with individuals' characteristics. We do that with female, age, and account side, which is a kind of proxy of wealth, very imperfect, of course, but a kind of. And what we see here is that the effect is stronger for male. So male are more interested in these social responsible funds, in invest more in equities when they're offered social responsible funds. Young participants are also much more sensitive, and those who have a larger account. And finally, we also add in the regression a dummy for a responsible equity investor in 2017 to check if the effect is driven by investment in social responsible investment in 2017. And what we find is that the effect is largely driven by real investment in social responsible products. So these are the results of the cross-sectional regressions. We do a robustness check in savings plans that have more than 50 employees, because as I mentioned before, these plans are mandatorily by law obliged to offer solidarity funds. And we find a similar effect, even if it's slightly smaller. But in these settings, the identifications comes exclusively from the difference between participants that are offered equity solidarity funds and those that are offered balanced solidarity funds. And because all of them are offered solidarity funds, but some of them are offered equity, some of them are offered balanced. And we showed that being offered an equity solidarity fund still leads to a higher asset allocation to equities by 0.48% in your asset allocation. Lastly, we are going to look at the results of the diff-in-diff regression, so the impact of the treatment. So now we are looking at how much do you invest in equity compared in 2017 compared to what you did in 2016 if you are offered a solidarity fund versus if you are not offered a solidarity fund. And here, if I highlight the main results here, and if you look at the second column, you see that if you are offered a solidarity fund, so if you're treated with a solidarity fund, you invest, people invest 6.8% more in equity than if they are not treated. Very interestingly, we did a placebo test, like what we do in medicine, by looking at what's happening if we introduce a conventional equity fund, like a normal equity fund in the funds menu. Here you see that the first column, that there is no impact, no significant impact. So people that were offered a new equity fund in the funds menu do not particularly react to that, do not invest more in equities. People offered a responsible fund in the menu, a new responsible fund in the menu, they react by investing more in equities. So it says that the possibility to invest in equity responsibly makes stock allocation more appealing to a significant fraction of individual investors. Then the question is why, right? Because it's quite puzzling result. Because if you think about standard finance theory, and as CFA members, you're well aware of all these questions. There is no reason why the offering of responsible funds should affect portfolio choices. So as long as equity investment is feasible, there is no reason why you should invest more in equities if this offering is social responsible. So why then do people invest more in equities? So why are they able to take more risk, willing to take more risk if we propose them responsible investment? There are two main possible explanations. The first one is the risk-return explanation. It may be that investors perceive the sustainability feature of responsible funds with a super risk-adjusted performance. They may believe that the social responsible funds, they will offer higher performance in the future. Another reason is the one I mentioned in the beginning, is related to the personal values. It could be that personal responsible funds attract investors that would have been otherwise reluctant to invest in the equity market because of social, cultural reasons, so the stock market aversion that we mentioned in the beginning. And if you propose them something which is more in adequacy with their values, they are more prone to invest in the equity market. So if we look at the first hypothesis, performance, if you look at past performance of solidarity versus conventional equity, there is no reason to believe, at least from historical experience, that could drive to expectations that solidarity fund should have a higher performance than conventional. It's quite the contrary on the history. They had a slightly lower performance, even if it's not significant. Then comes the personal values explanation. That is something we would like to investigate further. As I mentioned, it's possible that responsible equity funds may help these pro-social investors to overcome their aversion to the stock market. Another explanation is that responsibility could increase the trustfulness of the stock funds. That's an hypothesis that has been made by Guizot, for example, and reduce the anxiety when making financial decisions. Something that we hear sometimes is that, equity is risky. I may experience bad performance during bad times, during crisis time, but at least if I invest social responsibly, I will have a kind of social utility attached to that. I will do good, right? So that in a certain way can compensate the disutility of taking risk. So what we plan to do to test that is to run a survey of plan participants to identify the main channels which are driving this relationship between responsible investing and risk taking. So to conclude, what we find here is that responsible investing can increase the stock market participation, so the ability to take risk of a significant part of the population. So this research work contributes to various strands of the academic literature. First, the literature on limited stock market participation, as we have seen, and how to increase it, because it's really a major concern among policymakers and also academics, that there is very low participation to the stock market in general, and very low capacity to benefit from the risk premium in the long run. Also, we contribute to the role of culture and personal values in financial decisions, and also to this literature which is looking at the role of framing and more the behavioral finance literature, showing that the way you frame financial offerings, the way you present things, can influence portfolio choices. Importantly, I think this work has also some interesting policy implications. So there is this very important debate right now about this limited stock market participation. I mentioned it in my introduction for pension adequacy. So people are more and more responsible for their pension choices. So if they don't invest enough in the stock market, they might not have an adequate pension in the long run. So that's certainly a key issue for policymakers, but also for the development of the European Capital Market Union. It has been identified that the retail market participation to the stock market is a key driver to the development of the capital markets in Europe. So the European Commission, ESMA, have put that as a key challenge for the coming years to incentivize more participation in the stock market in the European Union. And what we find here is that the attractiveness of equity funds is not only linked to their financial performance, but also their ability to attract investors who otherwise may have been reluctant to invest in the capital markets. Thank you very much, and I pretty much look forward to discussing all these questions with you. Thank you very much.